What is going on, investors? Hopefully you guys are doing well out there. And if you own FASTLY shares, ticker symbol FSLY, I particularly send out some sympathy to you because during the regular session, this stock was down 3.6% down to 44.54, but it would have been probably wise to sell then because in the after hours, after reporting an absolute disaster Q2 guidance and numbers, which we'll talk about here in a second, this stock is down another $8, down 18% in the after hours to $36 per share. When we get over to the stock chart on this one, we'll talk about what this means from a technical level. Now, the reason why, really there's a couple reasons why FASTLY is absolutely getting decimated in the after hours. First of all, let's take a look at this Q3 guidance. Revenue is supposed to come in between 82 million and 85 million. Consensus on the street was at 97.9 million. That is a huge miss. For the full year 2021, we're expecting revenues between 340 and 350 million. The street had them at $382 million. Look, companies often sandbag these guidance to give them a little bit of wiggle room just in case they come into them. They don't want to have to revise down. Well, FASTLY not only missed the wiggle room, they missed everything, and that is why the stock is getting punished in the after hours. The other reason why the stock is getting punished is we're going to take a look at these financials right now. And look, we spent a lot of time here on the channel talking about companies like Facebook and Google and Amazon and Apple and even Tesla to a certain degree. There's a lot of companies that we cover here on the show that are doing absolutely electric numbers, and it's fun to look at them. But FASTLY is a great example, and I encourage you to watch this video in totality so you can learn what to look for and to run away when you see this type of numbers, because look at FASTLY stock as they started printing terrible numbers. I mean, this was a $135 stock just a couple months ago, and now we're talking under $40 per share. And a lot of it has to do with these numbers. We got our 3 months ended here. Left-hand column is our most recent quarter that we just spit out. The right-hand column is a year ago. We got a 6-month view year over year on the two right-hand columns as well. We got our revenue coming in from 74.7 million up to this 85. So they bolted on, what's that? A little over $10 million to that revenue side. Take a look at our cost of revenue though. It went from 29.7 all the way up to 40.3. Something is going on there when you only grow your top line by a little over 10 million bucks, but you grew your cost of revenue almost in lockstep. Guess what that's going to do? Absolutely destroy your gross profit. You went from, we'll call that $45 million worth of gross profit last year. Now you're sitting at less than that. You're actually making less. Even though your revenue grew, you're actually making less gross profit over at FASTLY. That is an absolute disaster quarter. Now, in terms of operating expenses, guys, could it get worse? Yeah, it does. Take a look. Our operating expenses on R&D went from 16.6 up to 30. Sales and marketing went from 24 to 36. And look at general and administrative went from 18 to 35. Hello. Total operating expenses went from 60 million all the way up to $102 million. That is over $40 million worth more of operating expenses off of only a slightly over 10 million worth of revenue growth. Whoever is running this company is doing an absolute terrible job. I'll say it here on the channel. Whoever's running FASTLY, this guy right here probably, is doing an absolute terrible job. And if you're a shareholder of this company, you'd be looking for this guy to walk out the door very, very quickly, because this is an absolute disaster. I can't exaggerate enough how terrible numbers these are. This is just an absolute disgrace and an absolute disaster quarter. One of the worst I've ever seen. Revenue growing by only 10 million. Our cost of revenue went up 10 million. So our margins contracted considerably. On top of that, we nearly 2x'd our expenses across the board. And that's an absolute disaster. Total operating expenses coming in at 102 million. That gives us loss from operations of 57.5 million. Last year, we're sitting at a loss of 14.4. So there are probably some investors thinking, well, maybe we've turned the corner. We're starting to turn the corner. Now we're only losing 14 million. Well, no, you just lost $57 million in a quarter. Last year, in 6 months, you only lost 26 million. It's an absolute disaster. whoever is running this company should be fired, period. Let's take a look at the balance sheet. It looks good. It's bolstered up by some cash. We'll talk about where that cash came from. They got about, what's that, about $900 million worth of cash, another 56 in receivables, all things being considered. It looks good up there. But take a look at long-term debt down here. Went up to $931 million from zero. That means our total liabilities went from $158 million. Last year, this company was in a really, their balance sheet was probably as good as you get. You only had $158 million worth of total liabilities. Yeah, that's sitting on the balance sheet pretty much in cash. Now you got $1.1 billion worth of liabilities bolstered up by this equity offering, which we'll talk about here in a second when we get to cash flows. Maybe cash flows paint a better story. We pull down that net loss of $58 million for the quarter. Again, last year for 6 months, they lost $26 million. Just in this quarter, they lost 58. Now, luckily, due to accounting rules, they get to add back in stock-based compensation of $33.4 million. So take a look at that. They put up an absolute disaster of a quarter, and they paid out more in stock-based compensation in the last 3 months than they did for 6 months of last year. It's just an absolute disgrace. People are getting rich off this stock, and they're not running the company very well. Flow through this cash flow statement, you get a negative cash flow of $17 million. That is about double of a loss where you were last year. You lost about $8 million on the cash flow side last year. All things being considered, absolute disaster. Issuance of a convertible note. This will get maybe converted over to equity. Whoever holds those convertible notes are watching the value of those things absolutely fall off a cliff. They issued those $930. That's where that long-term debt came from. They had a following public offering as well, $274. All things being considered, this company is diluting you very fast. Speaking of FASTLY, take a look at the dilution. You had 99,000 shares. Now you got 115 once this convertible note vest and those types of things, and all the share-based compensation that is going to employees. Employees are watching this stock go down. They're probably going to come in here and sell. All things being considered, this is a absolute disaster stock. Now, we did tell you about it. Back in May, we published a video on FASTLY. Got a lot of views, a lot of comments. I actually had to watch the video today to remind myself what I said. Back in May was this dip. So it reported earnings, had a similar type drop, had a big drop to earnings, but then we walked back up and filled that gap perfectly to 60, only to walk it all the way back down, and now we're at 36. On the video, I had these lines marked out. I said down here, $25 per share. You've got some demand for FASTLY down here at 25. And in fact, we're in the box of demand, okay? Because previously $40 was kind of an area of support. Notice the stock gap down here to 40 and then bounced all the way back. Came down here, looked like it wanted to hesitate right in this $40 range. Investors were wondering, what's this quarter going to be? We're either going to pop back up here to 60 or we're going to gap down. Guess what? We gap down. Now we're sitting down here at 36. Wouldn't surprise me if this stock continues to walk lower. Maybe it doesn't get all the way to 25, okay? But we're probably coming down $35, $30 per share, somewhere on that one. I could see it stalling out at $30 per share as well. Everybody looks at these charts. Everybody's going to have this $25 level marked in on this and say, this is where the stock is going to bottom. So looking at these financials, I would not want to buy this company. Their revenue is barely accelerating. It is just marginally accelerating. We're looking at companies like McDonald's. We're looking at companies like Facebook. We're looking at companies like Google that are just blowing up their revenue growth. Okay, this is barely growing. On top of that, our margins are contracting. Our other expenses are just absolutely gone haywire. This company is raising money in the equity market, so they're diluting you as a shareholder. Just nothing is looking good from any sense of this company's financials are not looking good. And look where they bury it. This is the last thing we'll do on today's video. So they come out with this shareholder letter, and look, they show you all these fancy little graphs and pictures and all this stuff. And this is meant to distract you as an investor. All this stuff is meant to distract you as an investor. Look where they put the financials, which are an absolute disaster. Where do they put them? Near the bottom of the document. Hoping that you won't get down here, hoping you don't understand how to read this. This is why we have the investor channel, to educate you, make you a better investor, and not be fooled by absolutely trash companies like this. 52-week highs at 136. Now we're sitting at 36. I think we're headed lower on FASTLY. Hopefully you guys enjoyed this video. We'll be back again soon with more Good luck with your investments.